So we just have that breaking news about how President Trump now has responded to the North Korean firing of that missile. So give us a sense from your experience, how do markets respond to these? How should they? What do you expect?
Well, markets hate uncertainty and unpredictability. And, as you and I were discussing earlier today, the market is really priced fairly if one takes into account the low interest rates that we have, earnings, and growth in the economy. But what it hasn't anticipated, and which it should fear, is exogenous events that cause the sense of calm to disappear. Those can be in the form of international conflagrations, like the situation that we see in Korea right now. They can be in the form of the failure of our U.S. government to effectively deal with issues like the debt ceiling, passing a budget. They can be, the failure of talks between Britain and the EU with respect to the Brexit discussions. All of those things destabilize the confidence that people have in markets. So I think we're fine unless one of these things, or more than one of these things, happens, and those are obviously almost impossible to predict.
So Ralph, today we have two different events, quite different events. One is Harvey and the aftermath of Harvey, the other is North Korea. Give us a sense of what's similar in those two events and how they affect markets, and what's different.
Well, Harvey is a human tragedy of immense proportions, and no Americans can sit and watch the pictures and not be deeply moved by people losing their homes or losing their neighborhoods. But from a market and an economy point of view, we have experience with this. And what typically happens from an economic point of view is you have a little bit of a weakening in GDP, maybe a couple tenths of a percent as unemployment goes up, refineries close, and then you actually get probably a little bit of a bump in the other direction as the cleanup and rebuilding happens. So in the intermediate to longer term, Harvey, in my view, will be a non-event from an economic and from a market point of view. North Korea is different. North Korea deals with the stability of the financial and the Western and Eastern world. And if you think about stock prices, they're composed of two things: earnings and multiple. And what collapses when people are concerned about stability is the multiple, more than earnings.
So we've seen before a reaction of the markets, and particularly the equity markets, to North Korean developments. We seem to be seeing that again today. What converts that from a few days of reaction and then return to normal, as it has been, from a true correction? What would have to happen for us to see a true correction triggered by this?
Well, if this led to some, I'm not an expert in this, but I've spent enough time on it to have a pretty strong belief that there is no really good military option in North Korea that doesn't involve risks to probably tens of millions of people on the Korean Peninsula and the surrounding area. That's obviously a horrible thing for the world and for markets as well. But I think we also shouldn't ignore the fact that we have coming in the next month or so here in the U.S. a couple of tests as to whether our government can actually function effectively. We have all forgotten how the market reacted to the debt ceiling challenges that we had about 3 years ago, and how the market reacted about 4 years ago when we couldn't get a budget passed through the Congress. So those are things that deeply undermine people's confidence in the effectiveness and predictability of our government, which is, after all, 25% of the world's economy.
And what difference does the president and his administration mean in those? I mean, they can't stop a Harvey. And even with North Korea, that's been a problem around for quite some time. Various presidents have dealt with it and have really had a tough time dealing with it. So how much of a difference does it make? Would the markets be in a different position with respect to these factors if it had been President Obama or President George W. Bush or President Clinton?
I don't think at this point that it would make a difference, certainly with respect to Harvey. I do think that in the next 2 to 3 months, we're going to have a number of opportunities to observe the predictability and stability of our current presidential administration. You know, the debt ceiling, the budget, and trade negotiations between Mexico and Canada and China. And if the world reaches the conclusion collectively that our administration is very difficult or unpredictable to deal with, that is a negative, not only for the markets, but for the world economy.
So given these uncertainties that we face right now, what is the lesson for the investor? I mean, how should the investor position themselves right now to prepare for the wide range of possibilities?
Well, there's been decades-long research about how difficult it is to figure out when exactly to get in and out of the market, and I'm pretty convinced by that research that no one can do that extraordinarily well. There are people, if we go back in history, there were people who became very famous for predicting the crash of '87 or the financial crisis in 2008. Unfortunately, most of those people predicted one of those things accurately, and then the next 7 predictions they had weren't as useful as that one. So, I mean, I'm certainly don't know anyone who's smart enough to figure out what's going to happen in North Korea in the next week or two, much less the next month or two. I'm not really certain how the trade issues get resolved. I'm not certain how the budget gets resolved. So, I mean, I actually am a believer in what Warren Buffett believes. You want to be invested in equities over the long run. You're going to have some exposure to volatility when you do that. But in the long run, equity values grow with the value of the world economy, and you know, there's nothing else out there that does that consistently.
You really deal with CEOs, the top CEOs in the country and around the world. What are you hearing from them about their attitude toward this marketplace, toward their business opportunities today?
Well, what they always are interested in is what is the future direction of the economy and what is the future direction of public policy and how that might affect economic growth and economic activity. And I would say, you know, there's a little bit more uncertainty today. If you went to the beginning of the year, there was a presumption that we would get, you know, quite a bit of regulatory reform, which we've started to see, a reduction and reform of corporate taxation, and hopefully some major investment in infrastructure as well. Much of the regulatory reduction can be done administratively, so that is not as dependent upon a cooperation between the administration and Congress. But everything else is, including the debt ceiling and the budget resolution, as we discussed earlier. And I would say those things, there's a concern, a little bit of concern out there. Is our government going to function effectively? Are we going to get some of the changes that would make America more competitive? And I think that's caused people to be a little bit more cautious than they might have been 6 months ago.
But does that mean in real terms we're seeing a slower rate of M&A today because of the uncertainty in Washington?
We are seeing I mean, statistically, there is certainly a slower rate. I mean, the environment is still very good. I mean, we had a very high peak in 2015, a little lower in 2016, and so far 2017 is a little lower. Where it really manifests itself is in the transactions larger than $5 billion, the larger deals. And activity in that size transaction is down, you know, not horribly, but down from even last year.
And is that because a CEO literally takes into account what might happen with the tax code, for example, or with trade negotiations as they pencil out the deal, or is it more of a general sense of sort of unease?
Well, there's you know, the hardest thing to measure in the propensity to do M&A is the confidence, or what sometimes is referred to as the animal spirits of corporate leaders. Easy to measure is, equity prices are good today, debt is accessible and reasonably priced, the economy is growing at a reasonable pace. So all of those things support M&A activity. The one critical component, which there's no government statistical measure of, is how confident do CEOs feel and how predictable do they feel the next 12 months? Because nobody wants to do a deal that right out of the gate looks, why did you do that? And so uncertainty definitely dampens particularly larger M&A transactions.
So there's uncertainty, but there's also valuations. To what extent are CEOs deterred by the fact that the valuations are so high and therefore they might look like they paid too high?
Well, valuations, you have to remember that the valuation of the buyer's stock is also high. And so, some of these transactions are done on a stock-for-stock basis. So you're trading one fully valued currency for another fully valued currency. And second of all, debt is very available and very cheap. Literally any transaction that a company does for cash, for debt, is accretive and pretty strongly accretive. That's not the way I believe you should measure a transaction, but in the short run, it does have a very positive effect.
And finally, Ralph, what about Evercore's business particularly? You've grown quite a bit. How has that advisory fee business, which all the banks seem to be after today, how has that changed in the last 5 years or so?
Well, I think the most profound change, quite honestly, is the movement in market share from the large universal banking firms to the independent firms. And Evercore has certainly been a major beneficiary of that. We track our market share of advisory revenues for all the publicly reported companies. So that would be all of the large US firms, some of whom have commercial banking backgrounds, some of whom have investment banking backgrounds, all the European firms, and all the public independent firms. And our market share of advisory revenues from that group of firms has literally trebled in the last 6 years. And that's happening because many of the most talented and senior advisory bankers who want to play the role of trusted advisor are migrating from the larger firms to the independent firms.
And what caused that? I mean, you've been quoted as saying you don't want B-plus bankers, that you'd rather leave the job open. Why is that?
Well, what we do is actually pretty hard, and that is to be hired by a company, its executives, its board, solely on the basis of our ideas, our intellectual capital, and our relationships with important players around the world. We don't have a balance sheet. We don't lend any money. And there are, a limited number of people, many of whom are talented in the large firms, that can do that. And, what we've been able to do is each year attract a few more of those people to our firm, and that's ultimately what fuels growth.
It's all about the talent in the end.
It is about the talent. It's not a lot different from a basketball team.